Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my special guest, Dane Moeller of Primary Residential Mortgage. Both Mark Hahn and Nam Phan are off today. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during the show. That certificate's not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in, San Francisco and 1 in Marin. Today's trivia theme is football in the movies. Now, they're not necessarily football movies, but there's something to do with football and somewhere in the movies, okay? Because I asked the same question on my sports show, and the guys were saying, wait a minute, that's not a football movie. I said, well, that's true, but it's movies that have something to do with football in it, okay? All right, so Dane, you're the main head honcho there at Primary Residential Mortgage in San Rafael. Give us an update. Things have been kind of crazy with interest rates going up.
Yeah, it's been an interesting year. Obviously, we've had interest rate increases. Really, they started right about the first of the year. It was kind of like, okay, 2022, let's start going up. And pretty steady through April, and then a little calm, and then another big increase through June. And then here in the summer, we've had things come down a little bit, stabilize. We're kind of in a range that we can depend on. So it's starting to kind of calm down in the, say, mid to lower 5%, after, a year ago being in the high 2s, low 3s. So a big jump, but starting to calm a little bit, which is nice. I'll take flat over increasing. Certainly.
Yeah. Well, we've had what, 3 75 basis point increases, haven't we, in the primary?
I think it's a 50 and then 2 75s. I think.
Oh, was it that? Okay, close enough.
Yeah, and the Fed. So mortgage rates are based on mortgage-backed securities, which are traded every day, just like a stock. And so the market is always kind of ahead of the news, just like the stock market is, right? It's buy the news, what do they say? Buy the news, sell the event, kind of thing. So the Fed, however, they meet once a month or sometimes once every other month, and they're usually behind the trend, trying to catch up. So if you look at charts in the past, mortgage rates rise ahead of inflation. Then the Fed figures out they're late to the party, and then they start raising their interest rates. And by the time they're done, mortgage rates have come down because they're already said, hey, the Fed is going to be somewhat effective in knocking down inflation. We can move down in anticipation of that. So I think we'll see mortgage rates come down before the Fed stops raising rates.
Well, that gets right into our email question, because I don't want to ask you after the fact. So this question comes in, says, when should we see a slowdown in the rise of mortgage rates?
Well, the answer is that we already have seen a slowdown in the rise of interest rates.
Okay.
Just like we've seen a slowdown in the rise of home values. Doesn't mean home values are going down, but they're not appreciating as quickly as they were, right? So they're not.
Now is that in the Bay Area? Because in some markets, prices actually have dropped, haven't they?
There are some. Well, it's hard to say because the data is delayed. What we are seeing in a lot of markets is sellers are lowering their purchase price, and not selling at their original price that they listed their house for. In some markets, up to 70% of sellers are reducing their prices, but their initial price might have been unrealistic, right? They might have said, well, my neighbor sold for X, so I'll go X plus 2, just because that's what the market is supported.
Gotcha. So them lowering that unrealistic expectation is not a drop in the price.
Exactly.
Yeah,
so
that's a good point.
When we get the data from this quarter, next quarter, we may see prices come down a little bit, and some markets probably will do that. I would say other markets will be a little flatter. Here in the Bay, I'm not expecting to see depreciation. I'm just not expecting to see double-digit appreciation. It's probably going to be more.
Which is healthy, really. Yeah. I mean, a nice steady. It's like inflation. A little bit of inflation actually isn't bad. It's just when it goes crazy. Yeah, you don't want deflation. That's actually scary.
Deflation is really negative for our economy in so many different ways. A little bit of inflation is healthy and makes the economy run a little bit better, lowers everybody's debts over time. but it keeps you understanding what things cost and not having to constantly change wages and businesses. There's a lot of expense for a business to change its prices and deal with other prices changing on the things it's buying and change its employees' wages. It's very expensive to deal with high inflation, and it leads to hoarding, which causes more inflation, right? But deflation, man, that's awful, because with deflation, there's no point in buying at all unless you have to consume it right away, because it's going to be cheaper later. And then if no one's buying at all, guess what? And then there's no demand or low demand versus supply, and then that's a spiral. So the best place, I mean, I disagree with the Fed on a lot of things, but the 2%, 3% target, I think, is exactly what they should be shooting for in terms of inflation. And I think home prices.
I'll be a little nervous when I start seeing the breadboards come out and the erasers come and they keep changing the prices by the hour like they did in the 1930s in Germany. I tell you what, let's go to our first commercial break trivia question. Football in the movies. In which movie does Sean Penn crash the car of his high school star's football player, high school's star football player, angering the latter so greatly that he nearly puts the entire opposing team in the hospital during the next game? All right, that's our trivia question. The first caller with the correct answer is going to win that tanning certificate. Call 888-912-1190 to answer this question. In which movie does Sean Penn crash the car of his high school's star football player, angering the latter so greatly that he nearly puts the entire opposing team in the hospital during the next game? All right, stay with us. You're listening to The Best of Investing. Don't touch that dial. We're going to be right back. Welcome back to The Best of Investing. Edward Brown here, along with Dane Moeller of Primary Residential Mortgage. Our first trivia question, football in the movies. In which movie does Sean Penn crash the car of his high school's star football player, angering the latter so greatly that he nearly puts the entire opposing team in the hospital during the next game?
On Fast Times at Ridgemont High, he could have crashed a car, but I'm going to go with All the Right Moves as the answer to this one.
No, actually, it was Fast Times at Ridgemont High. Yeah, you're thinking of all the Right Moves with Tom Cruise, which is actually a pretty good movie. Ampipe, I think, in Pennsylvania was the name of the school, but I don't think he crashes the car though.
Well, I just remember that there was some sort of football thing in that movie and Sean Penn, but I guess I'm going with my first answer. All right.
You should always go with your first gut one, which is so funny because there's so many famous people in that movie.
Oh,
with Phoebe Cates and Judge Reinhold and Ray Walston from My Favorite Martian from the old days. Remember that? Let me take a quick break from what we're talking about on the mortgages to address something that looks like it's getting passed with regard to student loan debt. Now, I have a question. For those people, and this has been all over the news, okay, the president wants to forgive $10,000 for people who have student debt who I believe make under $125,000.
Yeah.
And if you make over that, I'm not sure what the forgiveness is, or if there potentially you could get.
I don't think there's any forgiveness about that, although it is $250,000 for married couples.
Okay, but is $10,000 the absolute maximum that they're going to forgive? Okay. All right. So, first of all, what about us people who were nice enough to pay our debts? I know Elizabeth Warren was asked this question a couple of years ago. Hey, this guy came up to her and said, well, if something like this goes through, will I get a refund? She goes, oh, no. And it's like, okay, so you're kind of basically punishing people who paid their debts on time. You're helping people who decided to get whatever career. A lot of people couldn't afford college. A lot of people didn't go to college for various reasons. And then, what happens if suddenly the government says, let's also kind of throw this onto mortgages and let's just start forgiving mortgages. Now, mortgages are maybe with the bank, but I guess the FHA, there are some government agencies involved. But, what I thought it was not un-American to just kind of the government just coming in and just kind of doing this. What are your thoughts on this?
Well, I mean, I have a few different thoughts. The government, so student loan debt in this income level is disproportionately with minority Americans. And our government does lots of things that aren't exactly fair from a standpoint of me versus you to, lower the gap between minority citizens and non-minority in our economy, right? And this is just something I would put in that same bucket. Now, it's not a requirement that you're a minority, of course, but that's who it helps more proportionally. And if you think about it from that aspect, we spend tons of taxpayer dollars that you may not say are fair on programs that help.
Yeah, no, that's it's just like another tax. But then why don't they go back to the colleges who benefited from all of that money and their endowments and let them pay it rather than.
And you can look at the PPP loans that went to businesses, some of which absolutely 100% needed those to stay afloat and support workers. Then you have other ones, and we all know people who received those and didn't have to pay them back and said, yeah, I didn't really need it, but it's money in my pocket, right?
Exactly.
And how is that fair to someone who didn't own a business, right? And pays their taxes.
Absolutely.
And has been a worker, right? There's all kinds of stuff that's not fair. Now, coming back to mortgages, which you talked about, the government forced mortgage servicers to honor forbearance during COVID and not collect payments from people, and then force them to put those debts on the back end of the mortgage or make that an option, let's say, which may or may not ever be collected, right? So, the government has, in a way, forced mortgage companies to forgive payments, maybe not principal.
Yeah, I mean, it definitely is a cost. It is definitely a cost. But it's one thing to just absolutely $10,000 forgive it and it never has to get paid back. On a mortgage, you're right. That's a good point. But it gets tacked onto the back end. The time value of money. If you're 3 years into a 30-year mortgage, it's almost like free money.
Yeah, I mean, are you gonna worry about that 30 years down the road? And now these mortgage servicers, not that I feel sorry for them, but they still had to pay their staff, right? They still had to honor their obligations, pay the investors, pay Fannie and Freddie, and they weren't collecting payments.
Plus the thing is, it potentially could hurt their credit because even if it's not necessarily reported as a ding against their credit, a lot of times it was reported as a memo. Yeah. And when they're going to get a new loan, the banks are looking at that and going, wait a minute, it looks like you got a forbearance or, some kind of an issue with your mortgage. I wonder if that's going to happen with these loans, with the student loans. Or are they just automatically just going to reduce it? And,
it'll be interesting. And it'll also be interesting if there's taxes on it. Because back in 2008, 9, and 10, there was balances forgiven. If you remember, in those days, there was much less forbearance, but there was a lot of modifications of loans. And some of the terrible loans, but people got behind and they modified and they forgave. And then people got big tax bills. Because guess what? If the mortgage company forgave $10,000 or $20,000 of your debt, even if it was a terrible loan, that's a taxable incident.
Forgiveness of debt is taxable. But you know what? That's a good point. I had not heard that yet. Yeah, boy, wouldn't that be a real slap in the face because it seems like it's a political move trying to buy votes. It just cut through the quick.
I mean, it's definitely a political mover. And I was reading, the effect of inflation, because right now we're in a fight against inflation, right?
Yeah.
And if you think I'm going to forgive debt, oh my God, I'm going to free up money to be spent. That's the exact opposite thing you want to do.
It's going to cause more inflation, yeah.
But if they really do start collecting payments in January, because right now people aren't paying their student loans, they have the ability to, we're still in the COVID era of everybody's in a zero payment type situation. So what I've read is if everybody has to actually start paying again in January and they get this forgiveness, it should roughly kind of equal out. And we actually shouldn't see much change in consumer demand. So maybe it's a way to soften the blow of people making payments again, because I'll tell you, people, we talk to lots of homeowners, we review lots of credit reports. Very few people are making payments on student loans or have been the last few years.
Yeah, the government. Okay, you know what? We have to cut to another break. We don't have time for a trivia question. We're going to push that off to the next one. All right, stay with us. Best of Investing. We'll be right back. Welcome back to the Best of Investing. Edward Brown here along with Dane Moeller. No trivia question on this commercial break, but we'll ask the other one next time. So we were talking about student loan debt and all that, and you know, you go back and I think if I remember correctly, hearing a couple of nights ago, the CDC said, "Oops, we got it all wrong." And you know, you think if they would have just let the economy just be, and some people would get really sick with COVID, some people wouldn't. It seems like the effects are worse than the disease itself. You know, that's what's, you know, more suicides, more alcoholism, you know, paying people to stay home. And it's a whole thicket. It goes beyond our show. But that's my little tirade there. So Dane, right now, let's talk about what kind of rates are in existence right now. Because you've got 15-year, you got 30-year, you got adjustable, you've got low balance, high balance, jumbo. Give us the realm and why people should deal with you. And again, don't forget to give out your information if people have questions.
Yeah, absolutely. Well, first off, with my information, again, my name is Dane Moeller with Primary Residential Mortgage. Number here is 415-870-2752. We're located in San Rafael and also San Francisco and have offices nationwide as well. In terms of interest rates, every scenario is different, as you'd imagine, and I have to always say that. Each person will qualify based on their own situation. But for best case scenarios, we're seeing 30-year fixed rates in the low fives, 15-year fixed rates down around 5, and adjustable rates, which are fixed for a time period and then adjust afterwards, available in the high 4s.
How long are those fixed for usually?
5, 7, or 10 years are the most common. 7 years is kind of the one we see most commonly.
Yeah, because a lot of people move within that 7-year period, don't they?
Yeah, it's been a few years since I've seen it, but the average loan in California only had a shelf life of like 36 months, 37 months. Because people move, people refinance. You know, I think that for anyone who's bought a house this year, I would say there's 2 to 1 or 3 to 1 odds they'll refinance within the next 24 months. So, you know, taking an adjustable rate when rates are higher makes a lot of sense because you can save money and you can feel confident, hey, there's going to be a chance I can refi. Of course, no guarantee, right? Today could be the lowest rates for the rest of our lives. Who knows? You know, so you don't want to put yourself in a position where you have to refi, but it does seem likely, and I would bet on it. I would bet on interest rates for 30-year fixed. It's kind of stabilizing in the high 4s towards the start of next year. That would be where I see things kind of settling out when a lot of this turmoil is over. Jumbo, those are jumbo rates. Jumbo, we're in a time period, this happens sometimes, where jumbo rates are better than conforming, meaning larger loans actually get better interest rates, and we're in one of those time periods. Conforming loans are a little step up from that, but pretty similar, mid-5s.
Is that because larger loans are more apt to be for people who are very responsible in paying?
The requirements are stricter than conforming loans, but it's mainly due to the fact that jumbo loans are purchased by large banks who then hold them in their portfolios. And they have a level of clientele that they want to maintain, and they will offer attractive interest rates compared to their competitors to get those clients. Where conforming loans are sold back to Fannie Mae and Freddie Mac, who then securitize them and sell them in the open market. And there's a tremendous amount of tax built into any of those loans. Our government keeps passing taxes that have nothing to do with real estate, but they're paid by homeowners through their interest rates. So those taxes oftentimes will push the interest rates above the jumbo loans, even though theoretically, without the taxes, they'd be quite a bit lower.
So let me ask you a little bit of a change of subject on this. You've been around for a long time, and a lot of mortgage companies are laying off people because the interest rates are going up. People aren't refinancing as much. The housing market slowed a little bit. Some people are canceling their contracts, etc. What are you seeing? Because I mean, you're still around.
Yeah, I've been doing mortgages now for 20 plus years, and I plan on this is what I do. Mortgage applications, the number of people applying, purchase or refinance, hit a 23-year low last week, 25-year low. So the volume is not there. And our industry hired tremendously to deal with the volume in the last few years. And companies are, companies that were more transactional and more based on advertising on the internet, they don't have the relationships to continue to keep the wheels turning over, and they have to lay a lot of people off. We're more of a relationship company, and we have long-standing partners with great referral partners and clients, and we've just done a good job for a long time. So we're able to keep on our whole staff. We're still staying busy.
Well, very similar to Pacific Private Money, they've actually been growing. The demand, maybe it's slowed down a little bit, but with other banks pulling in the reins, it seems like it's actually produced a little bit more volume for them, which is kind of interesting.
Yeah, and I would imagine that some of the things like bridge loans and short-term loans that you guys specialize in at Pacific Private Money would be in more demand as mortgage rates get higher, because people maybe want to just pay cash for their next house and need that bridge loan to do it, where when rates were 2.5% or 3%, they say, well, I'll borrow and take a mortgage because that's so cheap, so it could raise your demand.
All right, let's tell you what, then we're going to cut to another commercial break, and now we have a trivia question. In which movie does Morris Chestnut, and I don't know him outside of this movie, play a character named Ricky Baker, a high school football player whose life is tragically cut short before he can go to college, where he is set to receive a scholarship? It's kind of a tough question, all right? Call 888-912-1190. First caller with the correct answer is going to win that Tandy certificate. Don't touch that dial. The Best of Investing will be right back. Welcome back to the Best of Investing one more time. I'm Edward Brown, your host, along with my special guest, Dane Moeller. Second trivia question is, in which movie does Morris Chestnut play a character named Ricky Baker, a high school football player whose life is tragically cut short before he can go to college, where he is set to receive a scholarship? And to give you a hint, Cuba Gooding Jr. and Ice Cube were in this movie. As well as Lawrence Fishburne.
Oh, I do know what. Oh God, what is that movie?
Come on.
That was a great movie.
It's a great movie. 5, 4, 3, 2, 1.
Coming to me.
Boys in the Hood.
Boys in the Hood. Great movie.
Great movie. Yeah, really like that movie. All right, Dane. You guys have tell us. You were just telling me just before we went on from the commercial break something to do with ADUs.
Yeah. So accessory dwelling units, or ADUs, hot topic over the last couple of years. The state has mandated that all the cities and counties really lower their barriers. You can't, the setbacks don't apply, and density doesn't apply, and all kinds of things to allow people to build ADUs. Yeah. Along with that, the California Housing Finance Authority, who we partner with, has issued a $40,000 grant to anyone who's doing a renovation loan to build an ADU. So we offer those renovation loans. We partner with the homeowner and the contractor and architect if they're involved, and access the funds to build the ADU, but then also get a $40,000 grant, which is not a loan, it's not a lien, it's never has to be paid back, that the homeowner can use to pay all their soft costs, everything that's pre-groundbreaking. So pay your permits, pay your architect, pay your site prep, pay PG&E, do all that stuff, and pay all the loan expenses, $40,000 of free money. And then once the loan is complete, our construction finance team works with the contractor to make payments and pay out, and an ADU gets built. So it's a pretty cool program, a lot of excitement around it.
Yeah. And now, does it matter if your ADU is, let's say, going to cost $100,000 versus $400,000? Is it still just $40,000? $40,000 is just a number.
$40,000 the maximum, but generally we were able to use it, use it all up.
Just in permit fees.
Well, but for ADUs, the permit fees are generally much lower.
Yeah, they are. Yeah.
They've tried to lower that. But yes, between architecture fees, permit fees, and then loan cost, we were able to generally use the $40,000 up. But it can be a junior ADU, it can be a garage conversion, it could be a basement conversion, it could be inside your home, it could be outside your home. There's lots of different ways to do ADUs.
Yeah.
And they all qualify.
Wow. So even prefab ones?
Yeah, prefab ones as well.
But what if you've already done one? Can you go back and get a refund?
You can't, just like you can't go, if you paid off your student loan, you can't go back and get your grant forgiveness. If you already built your ADU, you can't get the grant. But if you've started your ADU and you still need financing to finish it, you're still eligible. So just if you broke ground, it doesn't mean it's too late. But if it's done, you're out of the window.
I guess if it's done, then you have a final sign off on the from the inspector.
Yeah, and you wouldn't.
Otherwise, you say, okay, now I need to put another roof on or something, you know.
And it does have to be paired with a renovation loan that finances the building. That's how the state.
Gotcha.
I believe that's how the state makes sure that the ADU actually gets built, because they send out their $40,000 and they don't. It's not like they come and inspect. They rely on us as the banks to make sure that the ADU got built, and we do that through the renovation loan process.
Yeah, because there's never any fraud within California and the government. Never.
Never heard of it.
All those people who not only the PPP loans but unemployment and everything else. And the prisoners getting their money in jail. Yeah, they get that. Amazing. Wow. Don't forget, give out your information one more time, because now people have a reason to call you on ADUs as well as just regular old refinances or purchases.
Yeah, absolutely. Well, my name again, Dane Moeller with Primary Residential Mortgage. Number here, 415-870-2752, located in San Rafael and San Francisco, and offices nationwide.
And do you have programs where people can buy down the loan with the interest rate? You know, they pay points or whatever.
Absolutely. Yeah. So in almost all situations, you have an opportunity to pay upfront, which is paying we call it a buy down, or paying points, which is you pay more at closing to pay less in the long run. And generally, the banks will have kind of a actuarian table type thing. And if you have the loan longer than that, just like if you live longer than the life insurance company thought you would, you can win, and win big, by paying points up front. You can also do the opposite and pay less up front and have a higher interest rate. And if you have a very short time horizon, like in a year you're selling, you can theoretically pay no closing costs and get a little bit higher interest rate, but you come out ahead. And those are the sort of analyses that we do with every customer to figure out what's best. There's also a comeback of what's called a 2-1 buy down, or which is a program that was around for a long time and kind of went away, and it's come back. And that's where you can prepay the interest. So in your first year of homeownership, you pay a payment based on 2% lower than the rate you actually got. And then the second year, you pay 1% lower. And you actually prepay that interest at closing for the difference. But how it generally works is the seller will pay that for you, or the builder if you're doing new construction.
Oh.
So where it really comes in is, hey, I'm a new homeowner. I'm new in my job. I'm expecting to make more money over the next couple of years. I want to kind of ease into this. And the seller, or oftentimes it'll be a builder, will say, okay, well, we will, as part of our package, we'll pay that difference, 2% the first year, 1% the second, and then your payments will start small and then go up, and then 2 years from now you'll be at your regular payment. And that's something that, like I said, went away and it's come back, and we've been offering it for a while. I saw some other banks recently said they're going to start offering as well, and so it's another way to kind of soften the blow of higher interest rates. And if you refinance before those 2 years are up, you will have never paid that full rate, right? Which is, again, not a guaranteed strategy, but a strategy.
Yeah, when I had refinanced a building, the bank made me put up reserves, basically a year's worth of mortgage payments ahead of time. And so, I just borrowed that much and threw it into a bank account earning nothing, basically, and they just extracted it. So I just didn't have a mortgage payment for a year. All right, you ready and then suddenly, okay, now a year's up. Okay, you got to start making the mortgage payment. All right, I'm going to cut to our last commercial break, last trivia question here, talking football and the movies. In the 1994 film Forrest Gump, the title character has such exceptional running skills that he gets a scholarship playing college football? Which legendary coach does he play under? Call 888-912-1190. First caller with correct answer wins that tanning certificate, which, by the way, is worth $100. In the 1994 film Forrest Gump, the title character has such exceptional running skills that he gets a scholarship playing college football. Which legendary coach does he play under? All right, stay with us. You're listening to The Best of Investing. Don't touch that dial. We'll be back with some closing comments. Welcome back to The Best of Investing. Last time for today, I'm Edward Brown, your host, along with Dane Moeller. Third trivia question. In the 1994 film Forrest Gump, the title character has such exceptional running skills that he gets a scholarship playing college football. Which legendary coach does he play under?
I'm going to go with the legendary Bear Bryant.
That is correct.
Right.
From Alabama. That's right. Remember, he says, I come from Greenbow, Alabama. Very good. All right. So let's see here. Last couple of minutes, we'll talk a little bit about Pacific Private Money. We are expanding quite a bit with regard to raising money specifically for our Freedom Fund, because we're paying interest rates to investors anywhere from 7 to 9%, depending upon how much they invest. The catch, so to speak, is that you have to be an accredited investor. So you have to have a net worth of at least $1 million exclusive of your home, or you have to make $200,000 a year if you're single, $300,000 if you're married. So that's one catch. The other catch is there is a minimum of $250,000. So a lot of people are going to say, I only have 100,000. I'm sorry, you can't invest in this one. But the good thing about this, if you do qualify, is that it's fairly liquid, because even though technically there's a 1-year hold, we don't impose any penalty for taking the money out early. So all we ask is just give us 30 days notice. So it's almost like a money market fund, but you can't write checks on it. So you just put the money in there and wait, and you get your interest rate every month. And then one day you wake up and say, I want my money back. Just give us 30 days notice and we'll pay you back within the 30 days. And the reason we can do that is because we're making loans, and then we have trade partners who we sell loans to. So just like you were talking about with Fannie Mae, Freddie Mac, and all that, who do in the hundreds of billions, we're a lot smaller than that. We're just in the millions, but we'll probably hit close to $1 billion worth this year. So we're kind of rising up in the ranks. I think we're kind of one of the larger private lenders who do these owner-occupied bridge loans in the country. Our primary focus is California, but we're kind of getting a little expansive out there. So check us out at pacificprivatemoney.com, 415-883-2150. Best to go to the website. Check out, we have 4 different funds. Take a look and see what your pleasure is. And Dane, before we cut out, give out your information one more time, as you're quite the extraordinaire of information for mortgages.
Yeah, thanks, Edward. One more time, my name is Dane Moeller with Primary Residential Mortgage. 415-870-2752 is the phone number. And it's Primary Residential SF, as in San Francisco.com, if you want to check out our website.
All right, very good. Probably now is a good time before rates pop up again.
It's a nice little window. We're seeing buyers really kind of starting to hold the cards, and be a fair negotiating table between the buyers and sellers, and a nice little dip in interest rates. And, I think that, like we were talking earlier, we're not expecting depreciation in home prices. So, if you can get a good deal now and maybe at a better interest rate down the road, marry the house, date the rate. That's a lot of what we're seeing right now. So I think it's still a good time to buy. Certainly better to pay your own mortgage than someone else's. And if you're renting, you're paying 100% interest, and you're either paying someone else's mortgage or you're just putting your money in their pocket.
And you don't get that appreciation either. All right.
You don't get that tax write-off.
Or the tax write-off. Okay, here's our thoughts for the day. Why is the Irish economy so strong? Because its capital is always Dublin. I thought you'd like that.
Oh, that's a good one.
That's a dad joke. And how does Bigfoot know what time it is?
How does he?
by looking at his Sasquatch.
Oh,
That's
these are
that one's bad. I should have started with that one and ended with the other one.
Yeah.
All right. Tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions and probably having more dad jokes. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long.